Hi everyone and welcome to SCCA P4. We're going to have our session 6 because of the first day that we had a technical problem. We should have got the session 7 tonight, but we are on session 6. And what are we going to do on session 6? We're going to pick it from the valuations, acquisitions, and mergers session 1 that we started last week. And then we will go on to look at chapter number 10, which is valuations, acquisitions, and mergers session 2. Chapter number 11, 12, 13, and 14 are said is self-study. All of them had been recorded apart from chapter number 14 that is going to be you reading, because that one is straightforward. It's on management of international trade. It's on like World Bank, free trade. They are just straightforward. Otherwise, the 11, 12, and 13, you can pick them from the pre-recorded videos. It's just like me standing here teaching, and I've explained all those principles in there. Any questions that you have, you can. Okay, you need to be given, Walter, you need to be given passwords or access details, which of course I wouldn't be in position to give it to you. So what I will say is you need to send email to the interactive or your linked person and request for the 21 hours pre-recorded videos that has recorded the whole lecture, which you can supplement it with whatever we're doing here. Okay, so any question that you have, you can send them to me. So talk to or send email to the interactive, and they should be able to advise you on how to access those videos, the pre-recorded P4 videos. Brilliant. Okay, so the objective today is to quickly complete the valuation, acquisition, and mergers valuation session 1, and then we talk about the session 2, which is in relation to chapter number 10, and then chapter number 15, which will be hedging foreign exchange risk. So I am taking you straight to where we stopped last time. I'm taking you straight to where we stopped last time. And this is the lecture note. Last time we were doing the valuations. We did the international investment appraisal. We did the international investment appraisals, and then we also started the valuation. We did the dividend valuation, we did the free cash flows, and I told you that the free cash flows, I will recommend you look it from chapter number 2, because that is where we did that hard work there. And then we also look at the PE ratios and all those. Those are just basic ones, which you can review it. Okay, so I told you to look at them and listen to those videos. So I will pick you from the 3 acquisition types, which is the most likely to be seen in the exam room. Okay, having said that doesn't mean just discard valuation of the debt and all that. It just follows the same principle as what you saw in the F9, and because I have recorded that, the time that we have here, let's use it to do the most difficult ones. So let's go to acquisition type 3. Okay, and what are the types of acquisitions? Okay, the problem of the valuation using the free cash flows is that we all said, according to the free cash flow basis, the value of the company or the corporate value is the present value of the future free cash flows discounted using WACC. Okay, let me put you into the frame. So the corporate value is the present value of the free cash flow discounted using WACC. Last week and last 2 weeks, we learned how to calculate WACC. We calculated WACC of combined business. We calculated WACC of a normal company. We calculated project-specific WACC. Okay, and when we did the APV, we calculated the cost of equity and geared. The problem with this cash flow basis is because we have to use WACC. Which WACC should we use? And when we did the WACC, we made mention of the fact that every WACC should reflect business risk and then financial risk. And we concluded that the moment business risk will change significantly, or the moment financial risk will change significantly, or the moment both will change significantly, the WACC should also change. So when one company is going to buy another company, is that acquisition going to result into changes in business risk and changes in financial risk? The moment that acquisition will change any of these risks, either business risk or financial risk, that is calling you. The WACC you have to use here should also change. And because of this, that is why the business combination or acquisitions are divided into different types. And the type would determine which WACC or which discount factor you will use. How to generate the free cash flow is not a problem. It's the usual one that we learn from chapter number 2. But how to get the WACC is also the same as what we learn in chapter 4, 5, and then 6. And as we learn from there, the moment the business and the financial risk will change, the WACC should also change. And this has brought about 3 types of acquisition which your syllabus wants you to know. Okay. So anytime I am going to value a company and I need a free cash flow approach and I need a WACC, I will need to know which WACC I should use. If A is going to buy B, if A is going to buy B, and A is in the same industry, let's say A is in the education industry, and B is also in education industry. If you remember, we said business risk is associated with the industry in which the company operates. Therefore, if A is going to buy B and all these companies are in the same industry, then business risk is not going to change. So business risk has got something to do with the industry, and financial risk has got something to do with debt equity proportion. So if the acquisition in front of you, the 2 companies are in the same industry, it is flashing you that business risk is not going to change. If the question also tell you debt equity proportion is not going to change as a result of the acquisition, then indirectly the examiner has told you business risk is not changing, financial risk is not changing. If business risk is not changing and financial risk is not changing, then our current WACC should not also change. Because the moment any of those risks will change, that is when the WACC should also change. So if business risk is staying constant, financial risk is staying constant, our current WACC is appropriate. And that is what they refer to as acquisition type 1. So acquisition type 1, both business risk and financial risks are not changing. And if they are not changing, then the WACC I can use could be our current WACC. The WACC I can use will be our current WACC. So the present value of the future cash flows, those cash flows will be discounted using our current WACC. And that is what we've been doing so far up to now. Okay, now let's go to acquisition type 2. With acquisition type 2, the argument here is A is buying B. They are all in the same industry. It means business risk is going to stay the same, but the debt equity proportion of the combined business is going to change. So if debt equity proportion is changing, then financial risk is changing. So financial risk will change, but business risk will remain what? The same. That is what they refer to as acquisition type 2. Examiner is not going to tell you acquisition type 1, acquisition type 2. It's your responsibility to read it from the surface of the question to judge it. That's why I'm giving you these scenarios. So when you are about to use the free cash flows, this question should come up. You have to ask the question, is it going to be acquisition type 1, type 2? In the case that are they in the same industry? Is that equity proportion changing? So if they are in the same industry, business risk is unaffected. But if that equity proportion changes, then financial risk is going to change. If financial risk is going to change, then our cost of capital should also change. How do we evaluate such a measure and acquisition? Or how do we evaluate this acquisition? This type of acquisition where business risk remains the same but financial risk changes is what they refer to as acquisition type 2. So business risk is not disturbed, but financial risk is going to change, isn't it? In this case, we have to separate financial risk from business risk. We have to separate business operations and then what? Financing. And the evaluation technique that separate business and financing activities is what we learned as the adjusted present value. That is why I told you my main concern was up to the adjusted present value. From chapter number 2 up to adjusted present value, which is chapter number 7. From there onwards, everything, if you have realized, we are rolling them over. So if you know how to calculate adjusted present value, automatically you know how to calculate or evaluate acquisition type 2, where business risk is staying constant and financial risk is changing what? Significantly. How do we calculate APV? We said APV should be calculated as the base case NPV plus or minus the present value of the future cash flows associated with the financing, if you remember. So this is what we are going to do in here. So if you know APV, straightforward, you know acquisition type 2. And we said the APV should be the base case NPV plus or minus PV of the finance effect cash flows. Okay, and we said the base case NPV will be the relevant cash flows. I'm refreshing your mind on relevant net cash flows discounted using cost of equity and geared, and the cost of equity and geared can be calculated as using preposition 2, which says cost of equity geared is the cost of equity and geared plus cost of equity and geared minus cost of debt, debt 1 minus T divided by equity. Or you can use WACC of geared is equals to the WACC of the ungeared multiplied by 1 plus DT divided by E plus D. We've seen all these formulas some, if I have to joke here, some years back. So by now you should be familiar with them. And the WACC of the ungeared is the same as the cost of equity ungeared. Or the examiner will give us beta. If he gives us beta, we have to pick the proxy beta. And when we pick the proxy beta and the proxy beta is geared, we would have to ungear it. And when we ungear, then we put it in the capping. We don't re-gear because we are separating business and financing. We re-gear to bring financial risk. This time we are separating the two. So there is no need for you to re-gear in APV calculation. I'm just recapping. Okay, so put it in the capping and you will get the cost of equity ungeared. Come and sort your PV of the finance effect, which will be your issue costs. Or you can have the tax saved on interest, and then you can have your subsidy. This is how we calculate APV. Get the PV here, get the PV there, get the PV there. So this is what we are going to apply. So what do I tell students? Take time and APV, which is chapter number 7. If you take time there and then you are able to understand the APV well, when you come to acquisition, which is this chapter that we are dealing with, acquisition type 2, you just roll it over. You don't have to learn it twice. So all what you have to think of is that as long as the two companies are in the same industry and then the financial risk, which is measured by the debt equity proportion, is changing, it's acquisition type 2. The evaluation of the project should flow with adjusted present value. How is it calculated? You come here, you calculate the APV. If the APV is positive, then the evaluation is saying that the acquisition should go ahead. If the APV is negative, we have to what? Reject it. So that is the case. So let's quickly go to our lecture note. We pick this question to illustrate. I read. The directors of Hinka PLC are considering the acquisition of News Corp Limited, an unlisted company. The shareholders of News Corp Limited are willing to sell the business on first January 2009 for 500 million. From the perspective of the directors of Hinkal PLC, the projections of the performance of News Corp Limited are as follows. Current year 2008 projections during the planning horizon, okay, 2009 up to 2014. Profit before interest and tax, depreciation and amortization. Depreciation and amortization, profit before interest and tax. Interest charges, profit before tax. The assumed rate of corporation tax is 35% per annum. The terminal value of the investment is treated as a constant perpetuity equal to the free cash flows for the year 2014. The risk-free rate of interest is assumed to be 6% per annum. The return on the market portfolio is taken to be 13.5%, whilst an asset beta of 1.1 is used for purposes of the appraisal. Annual capital expenditure from 2008 onwards is estimated at 20 million each year indefinitely. News Corp Limited currently has on issue 400 million of 8% debt, and it is intended that all available cash flow should be applied to repaying this debt at the earliest opportunity. Advise the directors of Hinkal PLC whether to proceed with their acquisition. Okay, somebody will say that, how will we know that this is acquisition type 2? As a result of acquiring the new company, we have to go and bring in what? 400 million dollars, isn't it? So if we have to bring, News Corp currently has on issue 400 million. When we bring the new company to form part of Hinkal PLC, what is going to happen? We are bringing the new company's debt. So debt equity proportion post acquisition is going to change, and that is telling us the financial risk is changing. Question didn't mention their industry they are in. It didn't say anything about business risk. So what will you assume? You have to assume that business risk is going to stay what? Constant. But technically, because it's under that heading, that is the reason why that indication is not there. A very, exam question, the examiner is supposed to give you the clue. But if they don't give you any clue about either financial risk or business risk, your assumption is that they will stay the same. Okay, so here I haven't got anything about business risk. I'm assuming it's staying the same, but I've got something about change in the debt equity, because the new company will bring in debt. When they bring in debt, my debt equity proportion will change, and the moment the debt equity proportion changes significantly, financial risk has changed. So the basis is financial risk has changed, business risk is remaining what? The same. It meets the definition of acquisition type 2. Therefore, I have to evaluate it on the basis of what? APV. How will I get APV? APV is calculated as the relevant net cash flows discounted at cost of equity to get the base case NPV. And when we were learning free cash flows, I told you that the basic meaning of free cash flow is the same as the net cash flows. So I can say this is the free cash flow discounted at cost of equity. And when we were doing free cash flow in chapter number 2, we said the examiner could say calculate the NPV using the free cash flow method. Nothing has changed. It's like me telling you calculate the NPV using net cash flow. So basically, net cash flows is the same as free cash flows. Do I know how to get free cash flows from accounting information? Because the question has given me accounting information, which is the income statement information here, from the profit before interest and tax up to profit before what? Tax. I know from chapter number 2 that giving accounting information to get net cash flows or free cash flows, I have to pick profit before interest and tax, less what? Tax. Then I would have to what? Add non-cash items like depreciation, less increase in working capital, less what? Capital expenditure. This is what my principal is telling me how to calculate the free cash flow. So I come to this question: where is your profit before interest and tax? I need the present value of the future. Question told me currently these are the information. I'm not interested. I want the future. So I want the projected into the future, which is 2009 up to 2014. So I go and open my statement and we go by that. So I'll say yes. I have 2009, 20, according to the question, 2010, 2011, 2012, 2013, and 2014. This is more or less year 1, year 2, year 3, year 4, year 5, year 6, sort of. Okay, but they gave us specific years, so I'm using them. I need my net cash flow, which is the same as okay, Maria, here we are going to use free cash flows to what? We are using the free cash flow and discounting it with cost of equity what? And geared, because we are separating financing from what? Operations. If we are doing the normal free cash flows, then we would have done free cash flow to equity discounted using cost of equity. Or we will use the free cash flow discounted using what? WACC. The argument here is this. Okay, very brilliant question here. The argument here is this. The APV principle is telling us that we are separating operations from what? Financing. Unlike what we were doing in relation to the MPV, we don't separate financing from what? Operations. That is why we needed the WACC. And the WACC of an ungeared position, only WACC measuring only business risk, is the same as cost of equity measuring what? Only business risk, or cost of equity ungeared. So this is basically WACC in a situation where we have only business what? Risk. So the issue of is it free cash flow or free cash flow to equity and acquisition type 2 doesn't come in. Okay, because we have used the APV and we are separating the two together. Okay, brilliant question. So I will say, what will be my profit or earnings before interest and tax? The earnings before interest and tax for the future is given as, is it 96.70, 118.57, 142.83, 169.71, 199.48, and then 199.48. These are the earnings before interest and tax. You have to picture the way we calculated the free cash flow. I've got the earnings before interest and tax. Straightforward. I have to bring my tax. What is the tax rate? I go to the question. According to the question, the tax rate is 35%. Don't have to bring what? Interest. Remember, therefore, we are going to say tax rate is 35%, and that 35% of those figures will give us 96.7 times 35 is given 33.84 minus, and then 41.50 minus 49.99 minus 59.40 minus 69.82 minus, and then 69.82 minus. These are the tax figures. When I get the tax figures, I need to add back non-cash items like depreciation. I go to the question, have you got depreciation or any non-cash items before arriving at your profit before interest and tax? Question says yes, because they've given me depreciation and amortization. Amortization is the reduction in intangible what? Asset. Depreciation is the reduction in the value of tangible asset. All of them do not involve movement of cash. Therefore, I've got these depreciation amortization values. They are not moving by cash. Therefore, I need to add them back. So let's go and add them. So I'll say depreciation and the amortization. And the figures given there are 42, 44, 46, 48, and then 50, and last one is 52. When I have got this, it's still the template I'm playing with, and this is the same thing we did in chapter number 2. So refresh your mind on that chapter. So when I get the depreciation amortization added, I ask, is there any working capital changes? Question didn't say anything about working capital changes. I cannot force myself. I have to leave it. Then I go to the next stage. Is there any capital investment in the form of capital expenditure, buying non-current asset? When you read here, it's saying annual capital expenditure from 2008 onwards. We need the future. Somebody asked a question about it last time and I clarified. It's not a matter of I have just seen purchase of asset. That tell me that it's a capital expenditure. The question is, that purchase of asset, is it one-off or is it going to continue into the future? I want the future cash flows. So this one, they said 2008 onwards. And when you see the question, 2008 is now. So onwards means up to infinity. So my capital expenditure up to infinity every year is going to be 20 million. I go and put the 20 million here. Every year, 20 million minus. Okay. And then that will push me to bring me to my, this is the capital expenditure. And that will bring you to your free cash flows. So when I get the free cash flows, then I find the present value of that. So the free cash flows will be 84.86, and then 101.07, 118.84, and then 138.31, and 159.66, and 161.66. This is my free cash flow. It's the same as what we normally refer to as, net cash flow. It's what we refer to as net cash flows. So this is my focal point. I've got this net cash flows. I need the cost of equity and geared. To get the cost of equity and geared, what should I do? I go to the question, do you want me to use preposition approach or do you want me to use beta approach? The question will answer you. The question will answer you that I have given you cost of equity, so use this. Or I have given you WACC, so use that. Or I have given you beta, so use this. So let's go to the question and see which one was given to us. If you come here, they said, whilst an asset beta of 1.1 is used for purposes of the appraisal. So if it is 1.1, as a beta, then the examiner is expecting me to go by the beta approach. So I have to pick that proxy beta. If that proxy beta is geared, then I would have to ungear it before I will put it in the capping. So I will leave space here and I will say, let me go and calculate my cost of equity ungeared. So my cost of equity ungeared, I will use the capping approach, which is the risk-free plus the beta market return minus the risk-free. So I'll say, what is the proxy beta? The proxy beta is given to me as 1.1. When I pick that 1.1, I need to ask myself, this 1.1 beta, are you geared or are you ungeared? Question told me it is asset beta. And we all learned last week or last 2 weeks that asset beta measures only business risk. And any beta that measures only business risk is also called an ungeared word, beta. So if the examiner had given me the ungeared beta, which is also called the asset beta, there is no need for me to think about what? Ungearing it, because he had ungeared it for me. So once this is the asset beta, or in other words, equity beta ungeared, no need for me to ungear. So I have to put it in the capping formula to get the cost of equity ungeared. And according to the question, where is the risk-free rate? Question says that the risk-free rate of interest is 6% and the market return is 13.5%. So I'm going to have 6% plus 1.1 into bracket 13.5% minus what? The 6%. what will be my cost of equity? And that cost of equity is 14.25%. Then I have to go back. I come and do my 14.25% here. 14.25%. In the exam room, you can approximate it to 14% and go. I normally use my calculator, so I'm fine. So I'll say 1 divided by 1.1425, and first year is 0.875, divided by 1.1425, and that will give me 0.766. Subsequently, I press the equal sign, and I'm going 587, and then 0514, and this is 0.450 approximate. When I add multiply, it should give me the PV. And how much figures am I going to get? This is 84.86, 101 point, 1 minute. I'm picking a wrong figure. When we multiply, it's giving us 74.25, 77.42, 79.74, 81.19. This is 82.07. They use a different approach there. So let me bring you here. 161.66 multiplied by 0.45, and that is giving 72.75. 159.66 times 0.514, and that is that. Okay, so I have got the PV year 1 up to year 6. Just as we did in chapter number 2, is the same thing we are applying here. So PV year 1 to year 6, which is the sum of this 74.25 plus 77.42 plus 79.74 plus 81.19 plus 82.07 plus 72.75. That will give you 467.42. Hold on, I'm using a different approach as we did in chapter number 2. They did something here. It's applicable to this question only. What we learned will apply to all of them, because what they did there is that because we are going to project based on year 6 figure and it is constant, I can now project it from year 5 toward infinity. Okay, but as we know, if it is growing, I couldn't have done that because the growth rate will pick on the year 6 figure. So what I'm doing, just as we did in chapter number 2, will apply to all situations. So now I need to get PV year 7 to where? Infinity. How will I get that? I have got a perpetuity. I'm going to infinity. So perpetuity, are you constant or are you growing? Let's go and ask the question. Question is saying somewhere here, the terminal value of the investment, this paragraph, is treated as a constant perpetuity equal to the free cash flow for the year 2014. Okay, so the year 2014, the cash flow is said to be 161.66, and this is going to stay constant up to infinity. So my PV from year X7 to infinity will be the 161.66 divided by the cost of capital, which is 0.1425. Don't forget to multiply by discount factor of the base year. We use 2014 as the base year. The discount factor there is 0.45. If you look at what they did in your note, because they were projecting from X6 up to infinity, they use what? 2013 base rate, and that can only be done if it is constant. Okay, if it is not constant, the projection should start from what? Or should be based on 2014 figure. That's why I want you to do this. Okay, so how much will I get there? 161.66 divided by 0.1425 all times 0.45, and that will give me 510.51. When you sum them up, plus 467.42, that gives 977.93 approximate. Okay, so hold on the approximation out. This is how it's technically supposed to be. The approach they used because it was a constant perpetuity. So you can say from 2014 this figure will stay constant up to infinity. You can say from 2015 that figure will be constant up to infinity. If it's growing, 2014 this figure will be the same, but 2015 that figure wouldn't be the same because it ought to grow by that particular percentage growth rate. So what I have used, whether there is growth rate or is constant, it will kill all the situation. So I've got my PV total as 977.93. What will be the base case MPV? I have to less the initial investment. If you go to the question mentioned that up here that they want us to pay. If you remember here, the shareholders of News Corp Limited are willing to sell the business on 1st January 2009 for 500 million. So if I had to buy the business, I have to pay 500 million in order to have access to the future cash flows. Mergers and acquisition is technically investment appraisals. Okay, mergers and acquisitions are technically investment appraisals because you are appraising as to whether you have to acquire that other company. So I have to pay 500 in order to get that. Therefore, what will be the APV or the base case MPV? When I less this, I don't want you to deviate from your normal APV calculation. What we did in the lecture note, we summed everything up, so that will bring you to the same answer. I don't want you to deviate, so I'll say this is my base case MPV, and that will be 477.93. Then I have to think about the finance effect cash flows. Remember, I've got my base case MPV. That's why I don't want you to deviate. Then I need my PV of the finance effect cash flows. Is there any issue caused there? Is there tax savings on interest? Is there subsidy? I go straight to the question to go and check. In the question, there is no issue cost, there is no subsidy, but I can see interest charges, and the interest charges are this, that, and that for the respective years, 2009 up to 2013. The moment I pay interest, it should save me what? Tax. What will be the tax savings? Tax savings is always the expense multiplied by the tax rate. Tax rate is 35%. So when I multiply the tax rate by this interest, I find the present value of that, and I have finished the present value of the finance effect because there is no any word issue cost or subsidized loan. So I will say PV of tax saved on interest. Tax saved on interest. I come out with the years the interests are supposed to be. If you read the question is telling us that the interest 2009, 2010, 2011, 2012 up till 2013. That is when we have to pay interest. What are the interest values? According to the question, interest here is 32, 26.88, 20.19, 11.73, and 1.28. These are the interests. I need the tax saved on them. So what is the tax saved? The tax rate is 35%. So I need to multiply by 35%. So 32 times 0.35 is 11.2. 26.88 by 0.35 is 9.41. 20.19 times 0.35 is 7.07. 11.73 times 0.35 is 4.11, and 1.28 times 0.35, and that is giving 0.45. Having got these tax savings, I need the present value of the future what? Tax savings, okay? Point of attention, when you are dealing with the tax savings, you need to ask the question whether tax is paid 1 year in arrears. Question didn't say anything, that's why I just went on, but I'm just bringing your mind on. Then I will need a discount factor. What discount factor should I use to discount the cash flows associated with the finance effect cash flows? If you remember from APV couldn't tell us what discount factor we should use. So we either have to use the cost of the debt or we have to use the risk-free rate. As we said, APV, that is the major criticism of it. Therefore, which one should we use? It's your choice. You can either use risk-free or you can use cost of debt. Okay, when I come here, this debt will cost us 8%. So I can use the 8% or I can use the 6%. Whichever one I will use is perfectly right. It's the major criticism of APV. So I am using 8%. So 8% here. If you use 6%, you are also right. So go to the table, pick 8%, which I normally use my calculator. So this is 0.926, 0.857, 0.794, 0.735, and then 0.681. And what will be the PVs? You multiply 11.2 times 0.926, and that is 10.37. 0.857 times 9.41, and that is 8.06. 0.794 times 7.07, and that is 5.61, and then 0.735 times 4.11, and that is 3.02. 0.681 times 0.45, and that is 0.31. Sum them together, and that is 10.37 plus 8.06 plus 5.61 plus 3.02 plus 0.31, and that is 27.37. So if this is the PV of the tax savings on interest, then I will add 27.37 to the base case MPV. This is where my focal point is. I've got the base case MPV. This is not applicable. This is not applicable. Only this is applicable. So my PV of the finance effect will represent only the tax savings on what? Interest, PV of it. So the moment I sum up these two, I should get my APV, which is the same as the corporate value. So 27.34 plus 477.93, and that is going to give us 505.30. If this is the APV, that is the overall value. So my overall value, which is the same as the corporate value, is this figure. But will the combined company have debt? Yes. And then you less your debt value. And what is the value of debt? According to the question now, we have to bring in debt of what? 400. So less the debt value of the 400, and that will give you the value you will give to your equity holders. So by bringing in this new company, my equity holders will have an extra value. So equity value from this project is 105.30, and as such I will say it will increase my shareholders' wealth, and this acquisition is perfect. We have to go ahead with it. That is why I've told you, sit down, master the APV. When you master the APV, come just here and roll it over. That is the end of it. Just come and roll it over. So that is basically the case with the acquisition type 2. Business risk is staying the same, but financial risk is going to change what? Significantly. That is where we need acquisition type 2, and we have to use APV. Because business risk is staying and financial risk is changing significantly, there is the need for us to separate the business from the financial risk. Now let's go to the last type of acquisition. Okay, let's go to the last type of what? Acquisition. Okay, so acquisition type 3. What is the acquisition type 3? Acquisition type 1, we said business risk stays the same, financial risk what stays the same. Acquisition type 2, business risk what stays the same, financial risk changes. Acquisition type 3, business risk is going to change significantly, and financial risk is also going to change. the two companies will be in different industries. And as a result of buying the other company, our debt equity proportion will also change. Then that defines what is called acquisition type 3. Both business risk and financial risk are changing, and that is acquisition type 3. How will I get the value of the business? The value of the combined business will be, as we said, is the present value of the free cash flows, is the PV of the free cash flows. We discounted the free cash flows using what? WACC. Now business risk is changing. Financial risk will also change. So what will be the WACC of the combined business? The WACC of the combined business, the new business, is calculated the same way we calculated the WACC of combined activities. The WACC of combined activities, if you remember, we said the company is doing activity A and is also doing activity B. Now, it's not activity. We have company A and company B coming together. And when they come together, they will form what is called company AB. Therefore, the WACC of company AB is the WACC of the combined world business. And how do we calculate that? Sit down at WACC of combined activity. If you have got it right, just come here, roll it over. How to get the free cash flows? Everybody know how to calculate the free cash flows from profit before interest and tax, add non-cash items, less working capital increase, less capital expenditure. You come and get your free cash flows. You go and calculate the WACC of the combined business, the same as WACC of combined activity. Discounted, you get the value of the combined business. That's the end of the case. Okay, so let's go to the lecture notes and then we pick this question to illustrate. Okay, Edward PLC is considering the acquisition of 100% stake in Coleman Limited in order to achieve backward vertical integration. Considerable savings are anticipated due to the combination of both the marketing operations and distribution networks of the two companies. Therefore, synergies will arise to create cash flows which are in excess of the current estimated cash flows of the two separate companies. Upon the acquisition of Coleman Limited, Edward PLC will immediately sell one of the warehouses of the target company, providing instant cash inflows of 5 million. The forecast cash inflows of the merged business are as follows. The forecast cash inflows of the merged business, so that is the cash flows of the two companies coming together, is the cash flows or free cash flows of the combined business. Examiner is not likely to do this in the exam room for you because the lecture note is prepared on the assumption that we already know how to calculate free cash flows from chapter number 2 through chapter number 9. Therefore, we are not going to show you how to calculate the free cash flow again. That's why this question had given it to you. In the exam room, unless you are extremely lucky for the examiner to give you that cash flows. And as we said, the free cash flow is the same as the net cash flows. So they've given us the net cash flows of the combined business. Okay, the forecast rate of corporation tax is expected to remain at 30%. The risk-free rate of interest is to be taken at 5%, and the expected return on a market portfolio is 9%. Information currently relating to the two companies is as follows. Edward PLC, Coleman Limited, market value, debt equity, total, beta asset, cost of debt. Edward PLC plans to make a cash offer of 380 million for the purchase of the entire share capital of Coleman Limited. This cash offer will be funded by additional borrowing undertaken by Edward PLC. Advise the directors of Edward PLC whether to proceed with the acquisition. Okay, or in other words, is the acquisition going to be successful? Acquisition will be successful if it will create additional value for our shareholders. That's it. Because our objective is to maximize the shareholders' wealth. So if it's to maximize the shareholders' wealth, is it going to create value for our shareholders? That is what we have to analyze. Okay, how will I know from the surface of this question that the acquisition here is acquisition type 3? We said acquisition type 3, business risk and financial risk are going to change significantly. Is business risk and financial risk changing here? Question went indirectly. As I keep telling you, examiner will not tell you business risk is changing, financial risk is changing. No. Okay. Here they said we have to purchase their shares for 380 million, and that will be financed through what? Borrowing. So there will be additional borrowing of 380,000, and that should tell you that our debt will increase. The moment the debt increase, the debt equity proportion will change, and when it changes, financial risk has changed. The new company we are bringing is also having debt of 20. So overall, when we bring this new company to form the combined business, we will have only debt of 100. We will have our original debt. They will also bring their debt, and then we also have to go and borrow the 380. So our debt will increase from 100 to 500. Isn't it a significant change? And that should tell you that your debt equity proportion has changed. Financial risk has also changed. Okay, now let's check business risk. How can we check the business risk? Question didn't give us the industries in which they operate, but we all said companies which are operating in the same industry should have the same business risk. And business risk is measured by what is called asset beta. So when I come to this question, they gave me asset beta asset here. The asset beta of Edwards is 0.9. The asset beta of Coleman is 2.4. As long as they do not have the same asset betas, it's simply telling me that they don't live in the same industry. And that is why they have different asset betas measuring different business risks. So here, business risks are different and financial risks are also going to change. Therefore, both business and financial risks are changing. This meets the definition of acquisition type 3. So you see how you have to be analytical. That's why I always tell you, you have to be interacting with the question, because the question will not just give you the answer like this. So when you interact through the principle, before the question will be opening the answers for you, because I need to check, is it acquisition type 1 business risk? Is it acquisition type 2? Is it acquisition type 3? If it is 3, business risk and financial risk to change. How will I determine financial risk? Is debt equity proportion, is it changing? If it is changing because I'm bringing in more debt, then it tells me it has changed. Okay, is business risk changing? Are they in the same industry? If it doesn't, okay, that is another way you can also bring it. That is another way. But what is more important is that you have to check the industry, and you also have to check what their betas. You can check based on their betas. Okay, vertical integration, probably I am buying my supplier. If I'm buying my supplier, we might be in the same industry. Maybe my supplier produces and sell computers, I also buy the computers and sell them. We might be in the same technology industry. So the key thing here is, are they having the same asset betas? The examiner will give you a clue. Okay, the examiner will give you a clue either through the asset beta or through the industry. Okay, so here, what should we do? If it is acquisition type 3, the value of our company will be the present values of the future cash flows of the combined business discounted using what? The WACC of the combined business. How do we calculate the WACC of the combined business? Just as we did with respect to what? WACC of combined activities. We said WACC will always reflect your business and financial risk. So my WACC, I'm just refreshing your mind on what we did earlier on the WACC of combined activities. My WACC should reflect my business risk and financial risk. My business risk, because now I have two businesses or two companies or two activities. I will face business risk in Edward's business, and I will also face business risk in Coleman's business. And this financial risk will reflect debt equity of my new business. Okay, how will I get the business risk of Edwards? Get the business risk of Coleman? I have to go to the industries in which these two companies are operating in order to go and look for a beta. When I get those betas, and those betas are geared, I don't need the geared, I need the ungeared. So I need to ungear them. When I ungear them, I will get the asset beta for this, I will get the asset beta for that. That measures the business risk. Then my overall business risk will be the combination of two. And if you remember, I told you, you don't just add them. You have to find the weighted average, because you are not doing 100% of them. So you have to find the weighted average to get what is called the combined asset beta. So when I get the combined asset beta, then I come and ask myself, is my new company going to have debt? If they're going to have debt, then I will face financial risk. I have to re-gear. When I re-gear, I put it in the capping and I'll put it in the WACC to give me the combined WACC. And that combined WACC is what I have to use to discount the free cash flows in order to get the corporate value. So this is what we are going to do. So first, I have to pick proxy betas from the industries in which each of them operating. I've got Edwards and I've got Coleman. What is their betas? I go to the question, what is the beta for Coleman? What is the beta for Edwards? They said 0.9, 2.4. So I come and put it there, 0.9, 2.4. I ask, these betas, are you geared or ungeared? Question said they are asset beta. If they are asset beta, then they are simply what? Ungeared. It means the examiner had ungeared it for me. If he had ungeared it for me, there's no need for me to what? Re-gear. So what will I do? Straightforward, I would have to what? Go to the next stage. There's no need for me to ungear. He's done it for me. So that stage, I have to skip it. Now, what will be the overall beta of the company? As I said, I've now got this, I've got that. Okay, what will I do? I have to get the combination, and the combination is not this plus that. You have to get the combined asset beta as the weighted average of the asset betas of the companies involved. So I'll have my combined asset beta. I will have the combined asset beta. You see how important the calculation of WACC using the Miller and Modigliani's, the geared and ungeared things are. That's the reason why I took time there. Okay, because when you miss them, it's going to perpetuate. When you miss them there, if you come to measures and acquisition, you will struggle. When you go to investment appraisals and you need your own cost of capital, you will struggle again. So make sure you are okay with those movements. So combined asset beta is the weighted average of these two asset betas. So we said the combined asset beta will be shown as this. Edwards asset beta is 0.9 multiplied by its proportion. We hold it on. Coleman is 2.4 multiplied by its proportion. What is their current market values and what is their current market values for each of the two companies? When we come to the question, the total market value of Edwards is given to us. Okay, be with me here. The total market value of a company is also called corporate value, and the corporate value is value of equity plus value of debt. So Coleman's total value, corporate value, is its debt and equity, which is the 1,000, and that of Coleman is 20 and then 280, which is what? 300. So the value of Edwards is 1,000. The value of Coleman is 300. Therefore, how do we find the weighted average on the basis of their market values? So I will say this is 1,000, this is 300. Total will be 1,300, 1,300. And what will be the weighted average beta? Okay, so 0.9 times 1,000, okay, plus bracket 2.4 times 300, all divided by 1,300. And that is giving 1.25 as my beta. 1.25 as the beta. Okay, so if this is the overall business risk the new company is going to face, then I will say, if you are measuring business risk, will the new business have debt? Obviously, the new business is going to have debt. As the analysis that we did earlier, we will bring Coleman's debt. We will also go and borrow additional 380. Therefore, we will have debt. If we have debt, then we would have to re-gear. So there's the need for me to re-gear. And to re-gear, we said the asset beta is equals to the equity beta geared. Equity over equity plus debt, 1 minus the T, on the assumption that debt is risk-free. When we did cost of capital, I made mention that if the examiner don't give you the debt beta, you assume that the debt beta is equals to 0. That's it. So I have got the asset beta combined of 1.25. Have I got equity? What will be the equity of the combined? Sum up the equities of the companies involved. The equity here is 900, here is 280. So I will say 900 plus the 280 will give us, is it 1180? What will be the debt? Coleman was having 20. Edward was having 100. We have to go and borrow 380, and that is the 500. So getting these two values, I put them in the formula. 1.25 should be equal to the equity beta geared. The equity is 1180. 1180 plus what? 500. Don't forget the tax. Tax in the question is giving us the forecast rate of corporation tax is expected to be 30%. So if it is 30%, this one will represent 70%. And what will be the equity beta geared? So the equity beta geared will be 500 times 0.7 plus 1180. Okay, multiply by 1.25 divided by 1180, and that is giving 1.62. So if I've got 1.62, this is the geared beta. If this is the geared beta, my next stage is I put it in the CAPM, and finally I put it in the WACC. So when I put it in the CAPM, CAPM says risk-free plus the beta, market return minus the risk-free. So my cost of equity will be, what is the risk-free rate? You go to the question. Question said risk-free rate is 5%, market return is 9%. You pick them quickly and then you move on. This is going to be 5% plus the 1.62, 9% minus the 5%. And what will be the cost of equity? So 1.62 times bracket 9 minus 5, okay, plus 5, is it giving 11.48%? So I need my WACC. What then will be the WACC? Isn't it cost of equity, equity over equity plus debt, plus cost of debt, 1 minus T, debt over equity plus debt. Then I have got my cost of equity to be 11.48%. Equity in the calculation, we said equity is 1180. 1180. Then I will say plus. Now be with me. What is the cost of debt? Let's go to the question. Cost of debt said, cost of debt of Edwards is 7%. Cost of debt for Coleman is 7%. I'm taking you to the next step. Assuming they were not 7%, what would you have done? You have to separate them. Okay, so I'm doing it as if they were not the same. So first, Edwards cost of debt is 7%. Don't forget to minus the tax. Tax rate is 30%. Here should be 70%. Okay, Then I will say Edward's debt. Come here. This debt we got. Edward was having this 100, and then he also went in for additional debt of what? 380. So Edward's debt will total 480 plus what is Coleman? Coleman debt, its cost of debt is 7%. So assuming they were different figures, this is how you would have to do it. And then this will be the tax effect, and Coleman's debt is 20%. What then will be the total? This plus that is 1180 plus 500, and that is 1680. Then what is the WACC? And that WACC is what is giving us 9.52%. It follows the same stages as, okay, it's following the same stages as the WACC of combined activities. So everybody who had taken the time to look at the WACC of combined activity, obviously you will follow a straightforward what I'm doing. It's just the name that we're changing. We're changing from activity to business. So if I've got more than one business and I have to bring all of them together to calculate my overall WACC of the whole combined business, I need the business rate from all of them. Weight all of them together. Then I need my whole financial risk measured by my whole debt equity proportion. Use it to re-gear, capping it, WACC it. That is the WACC of the whole combined business. So if I've got the WACC of the combined business, this is where my focal point is. When I get the WACC of the combined business, I am going to discount the combined business cash flows with the WACC of the combined business. Full stop. You have to compare like against like. Chapter number 2, we said when you are discounting cash flows, you need the appropriate discount factor. This is the meaning of the appropriate. You have to compare like against like. If this is combined cash flow, their WACC should also be the combined word. WACC. Simple. So I'm picking you straight from your note, telling you that if I have got the WACC and then giving you the following cash flows, I should be able to discount it at 9.25. Exam room, you can do it 10%. Go and read 9.25, which everybody knows how to read that. And then you discount this, and then you get overall value of the company as 142.97, isn't it? So the overall value of the company is 14297. This is what, if you remember, we call it the corporate value. Is the present value of the future what? Free cash flows. I've got the corporate value. If I have got the corporate value, have I got debt? If I have got debt, less the debt from the corporate value, that should give me what? The value of equity. So this is the combined entity value less value of debt. The value of debt is 500,000. 500. Then that will bring you the value of equity. Coleman, have we increased their shareholders' wealth? If you look at the question, Coleman, Edwards, that is the parent company. Edwards equity before was 900, and now if it is gone to 922.76, then we are making extra value of 22.76. As long as we have increased Edwards shareholders value from 900 to 22.76, we will say we have increased shareholders wealth, and therefore the acquisition to be what? Successful. That is the whole argument. So the problem here, I normally tell students, this chapter, the problem is not in this chapter. The problem is in the previous chapters, because if you know how to calculate the WACC of combined business, you just rolling it over. If you know how to calculate the free cash flows, you just rolling it over. Because I need to calculate the free cash flow, calculate the WACC of the combined, and then just multiply to get the value of the combined. So everything I'm saying now is something that we've done in the past. So review them well, and when you come here, you roll over. If you rush through them because you are in a hurry to come and learn this one, when you get to this point, unfortunately, you might not be able to appreciate it well again. So take your time, Understand those earlier one up to chapter number 7, which is the APV. The rest is just a rollover. The rest is just a rollover, as you can see so far. Okay, however, there is a problem on the analysis that we've done. So the examiner might ask you, what is the problem with the analysis that you've done? And I'm going to bring your mind on. Okay, when we were calculating the WACC, we said the value of equity is 1180. Value of debt is the 500 here. Okay, so when we were calculating WACC, let me summarize it. Debt was 500, equity was 1180. But after we had calculated the WACC and we discounted the cash flows to get the value of the company, so on the basis of the value of the company, debt was 500, but equity was 99276, like this. What has happened? What has happened is that there is inconsistency here, because we cannot say today that we are calculating the WACC, we will say equity value is this, and at the same time that equity value is also having a different value. It can't happen. The share value at a point is the same, whatever the case is. So the examiner might ask a theoretical argument that the analysis that you've done, what problem will come up? The problem that has come up here is that the debt equity proportion that was used to calculate the WACC should have given us a market value that will also have the same debt equity proportion as the WACC that we used. But unfortunately, the debt equity proportion we use for the calculation of WACC is not consistent with the debt equity proportion that came out as the market value. You haven't yet appreciated this, that to calculate WACC, I need market value. To calculate market value, I also need WACC. In simple terms, to calculate value, I need cost of capital. To calculate cost of capital, I need what? Market value. Simple example I can use to illustrate is this. When you calculate cost of equity using the dividend valuation, we said if the dividend is constant, then my market value will be equal to D divided by cost of equity. So to calculate this value, I need this cost of equity. When to calculate the cost of equity too, we said cost of equity is the dividend divided by P0 multiplied by 100%. To calculate this cost of equity too, I need market value. This is where the argument comes in. It's like the egg and chicken. Which one comes first? Because A depends on B, B depends on C. So that is the problem that has come up. Because when I was calculating the WACC, I used this debt equity, but the market value that came out ought to have been the same as that. They were not. So there is a problem here. The problem is simply there is inconsistency in the market value used to calculate the WACC and the market value that came out on the basis of what? Using the WACC to discount the cash flows. So what should we do? So the examiner will ask you, what is the problem here? The problem is simply the inconsistency, and he will go further to ask you, how will you resolve this problem? How will you resolve this problem? A question that I can refer you to for you to look at it is a question called pursuit. It's a question called pursuit. I think it's June 2011. Okay, you can also have it from your revision kit. It's called pursuit. Okay, pursuit. If you try that, that is what you can get all these things very, very broadly. Have a look at that. Any questions that you have out of it, let me know. It is a very, very demanding question. You are not going to get pursue type of question anymore, but the ideas or the principles from them is what I will encourage you to pick it. Okay, I will encourage you to pick those principles in there. Okay, so how do we resolve it? That is what your note is telling you. As there is inconsistency in the market value used for calculating WACC and market value used to calculate what? The market value that came out. Okay, that inconsistency should be removed. So if you have to remove that inconsistency, the simple common sense is the market value for the WACC should be the same as the debt equity from the market value in order to remove that inconsistency. How are we going to do that? We would have to use what is called the iterative revaluation procedure. So the only thing you need to put in your mind is when that inconsistency occurs, to resolve that inconsistency, we have to use the iterative revaluation procedure. Don't panic, it's not anything. Iterate means you are repeating. So the assumption here is we are going to do try and error to revalue the debt equity such that the debt equity that we will use to calculate the WACC, when we get the WACC and we use it to discount the cash flows, it will also bring the same debt equity from the market value. That will resolve the inconsistency in there, because this is what is bringing the inconsistency. So I am going to do try and error, revalue, get a WACC on the basis of a market debt equity ratio, so that when I get the WACC and I use the WACC to discount the cash flows, it will also give me a market value for which the debt and equity will be the same. And as such, there is no disparity or discrepancy in the two values. So that is the argument in there. That is the argument in there. Okay. And how to use the iterative revaluation procedure. Unfortunately, we cannot do it manually. It's a computerized program, and your syllabus does not want you to do the computerized program. Okay, so all what you need to know is remembering that where that inconsistency occurs, you have to use the iterative. We try to use the computerized program to resolve it for you. If you like, read this. If you don't like, don't bother yourself with this, because we were just illustrating. So what it's telling you here is that when we use the Excel program to do this try and error, we got a WACC which is equals to that, and the market values that will come out of this is this. Therefore, the consistency will be there. So that is the argument. The combined value is this. When you take off the value of the debt, you get value of equity as this. And then when you use it to ungear, regear, it will bring you to the WACC of 9.43. So the WACC that will bring that consistency is 9.43. You can't do it manually. It's a computerized thing. So my advice is pick it from the point of view of the iterative revaluation. Revalue until you come and get a market value for the WACC that will also give you a market value debt equity from that particular market value. And that is basically the case. High growth startups. High growth startups. What are the high growth startups? What do we mean by that? A company is a high growth startup if the company has just started and their intention is to grow quickly. That's the meaning. Your syllabus just want you to appreciate the difficulties that companies might go through, or the difficulties that you go through in valuing a company that has just started and its intention is to grow quickly. How are we going to appreciate the problems? In order to value companies, we have valuation techniques like the PE ratio method. And according to the PE ratio method says PE ratio multiplied by earnings per share is equals to market price. Companies which have just started are likely to be making what? Losses. So when you making losses, you have loss per share multiplied by PE ratio. Loss per share means it's a minus. It means the market price will be a minus. When I'm going to buy your company, you have to pay me. That will be very interesting, isn't it? Therefore, if the company has just started, for instance, making losses, it's not appropriate for us to use the PE ratio, because that method will result into a negative word, market price, and that doesn't exist. Okay, same argument. Companies which have just started, even if they would have to what? Making profit. If they will be making profit, then the profit, all of them will be what? Reinvested, because they want to grow quickly. So whatever profit that they are making, they are likely to reinvest it. We are not paying dividend. If a company is not paying dividend, we said dividend valuation is D0 1 plus G divided by cost of equity minus G. If dividend is 0, the market price obviously should be equal to 0. Not applicable, isn't it? If we have to use the free cash flows, most of these directors for such companies, they might not necessarily have the experience. There is no past information about the company we can use as a basis of predicting into the future. So that is going to be really, really difficult, because there are unknown competition or competitors. There are high development costs and all that. So all what your syllabus want you to appreciate is the difficulties that companies go through in valuing high growth world startups. No question has been asked, and high growth startups. Okay, should we be in position to predict the future cash flows based on whatever unrealistic assumptions a company can come out with? Then what will be the growth rate? The growth rate of such companies cannot be calculated based on past information. If you remember, we said calculating growth rate, we can either use the average method, or we can use what? The Gordon's growth model. And the average method is calculated based on past information. If such company hasn't got the past information because they've just started, this method is not applicable. So the only method we can think of using is what is called the Gordon's growth model. Is what is called the Gordon's growth model. And what will be the Gordon's growth model? You've seen all these before. Is G is equals to what? RB. R is the return on investment, and B is the proportion of the profit retained. If such a company is a high growth startup, whatever profit they want to get, they will want to what? Reinvest it. The moment we get the profit, we have to reinvest it. And how are we going to reinvest it? If we reinvest all the profit, it means none will be retained. If none is retained, then none will be distributed. All the 100% will be retained. So if 100% will be retained, then my B will represent what? 100%. Because every profit will be retained. Proportion of the profit retained is what is equal to the B. So the whole of the B will be retained. So if the B is 100%, then your growth rate is equal to simply your R. Your R is your return on the investment. Whatever return that I get, I retain all of them. So my company will grow by the additions. That is what happens. So let's take this simple example to illustrate. But as a matter of fact, this is not a question that relates specific to high growth startups. Your syllabus just want the knowledge to appreciate that is difficult. Okay, so let's go. Bednar PLC anticipate cost of 1,200 million in the coming year, thereafter growing at a rate of 4% per annum. The anticipated revenues for that year are expected to be 320 million. The company expects to achieve a return on reinvested funds of between 16% and 18% per annum. Furthermore, the directors of Bednar PLC do not anticipate the payment of any dividend for the foreseeable future. using a cost of equity of 20% per annum, produce a valuation for Bednar PLC based upon both the maximum and the minimum growth rate predictions using the growth model combined with Gordon's growth approximation. Okay, so if I have to calculate the value of the company, is the present value of the future what? Cash flows. I have got a cost and I have got revenue. Cost is increasing by 4%. By point of attention, question is saying that 1,200 is in the coming year. It's next year. And if you remember, we said the D0, 1 plus the growth rate is the same as D1. And D1 is the next year's. So when the question say the cash flow next year is that, it means they have already grown it for you. You do not have to grow it again. Okay, the same thing applies to revenue, and revenue will increase as a new growth rate, either at 16% or what, 18%, as long as they are not going to pay any dividend for the foreseeable future. It means whatever profit they will get, they have to reinvest everything. So the proportion of the profit retained is 100%. Your growth rate should be equal to your return on investment, which is given to you. So I will say here, straightforward, if my growth rate or my return on investment is 18%, what then will be my G? It will be 18% multiplied by, I am retaining 100%. So that will be what? 18% growth rate. You don't even have to bother yourself to calculate that. And then what will be the PV? This is where you would have to be with me. And that is the reason why I'm bringing this question for you to bring your mind on. It's not something that relates specific to startups. No. Everywhere you are doing the present value analysis, this happens. Okay. Every time, what we do is we deduct the cost from what? The revenue to get the net cash flows. What has this question done here? This question is telling us that you cannot do it because cost is subject to growth of 4%. Revenue will be subject to growth of what? 18%. Before two things can be compared, they would have to be of the same base. So I have to calculate their values separately. So for revenue, next year I will get 320, which is the D1, divided by cost of equity of the 20% minus the growth rate of the 18%. Okay, and then minus the cost is 1,200. The cost of equity is 20% minus this one. Its growth rate is 4%. If the growth rate were the same, if this and that were the same, we could have summed them up, factorized them up, and then sum them up. We will get the same answer. But because the growth rate are not the same, you cannot sum them up. So I will have to separate them. 320 divided by 0.2 minus 0.18, and that is giving us 16,000 here, minus 1,200 divided by 0.2 minus 0.04, and that is 7,500. So from the 16,000 should give us 8,500. We do the same thing if the return is 16%. The return being 16%, G obviously should be 16% multiplied by 100%, and that is 16%. What is the PV? I will have 320 divided by 20% minus 0.16 minus 1,200, 0.2% minus 0.04, just as we've done here. This one will bring you to 7.5, and then 320 divided by 0.2 minus 0.16, and that is what? 8,000, and the market value will simply be what? 500. It's just showing you something. So that is basically the case. That is basically the case. So we move on to chapter number 10, which I think you can review that one too, because if you go to that chapter, you will see that it is only discussion in there. So I want to use the opportunity to start the hedging, because that is another bigger question that you have to face. So review those chapters that I have referred to the videos for you. So let's go straight to chapter number 15, and I will start with the hedging. So review those chapters I've referred to you to the videos. So make sure you actually listen to them. Okay, if you want to listen to the whole of them, it's also brilliant, because that has recorded all of them, I think, apart from chapter 13 and chapter 20. Otherwise, the whole lecture note is also there, so you can review all of them. Okay, so the technical issues here are what I'm trying to resolve them for you. Okay, so if you come here, they are all notes that you can just review from the discussion. There's nothing technical in here. So let me take you straight to chapter number 15. And chapter number 15, we're going to start with the hedging. Okay, you can't go to P4 exams without hedging. No possible way. So let me try and use the time to address those ones. So when we go to chapter number 15, it's going to be hedging foreign exchange risk. Hedging foreign exchange risk. What is the meaning of this? The moment I talk about hedging, you are looking at two things. Either we are hedging interest rate or we are hedging exchange rate. Okay? Examiner used to be doing June currency or exchange rate hedge and December interest rate hedge. But recently, he's messed all of them up. The December 2014, he tested what? Interest rate as normal. So everybody was expecting that the June 2015 should be currency. And unfortunately, he repeated interest rate. And the September exam, if you have read the examiner's report, you will see that he tested the A, currency, and the second one was interest rate colors. So now, I reasonably believe it should be currency, but I don't want you to rely on the currency alone. Even though I do this analysis for my student, what are the likely ones? But I also tell my student, in addition, make sure that the other ones too, you have a look at them, because just as it happened in the June exams, everybody was expecting the currency to come in the June exams, and he repeated the interest rate. So anybody who didn't revise the interest rate, automatically the 25 marker question, you were out of it. So more or less, you are forced to answer the question number 1, question number 2, and question number 3. Because that question number 4, which was the interest rate, though straightforward, you didn't revise it, so you can't do it. So for hedging, I will beg you to make sure that you have actually done currency and interest rate all together. Because whether you like it or not, one question there will come from either interest rate or currency or both, as he did it in the September exams. Because he has now come out clear to say that some students are sporting and he doesn't want students to sport, so he's not going to give a pattern. And I've seen that in the current from December to this time, because the June exams, typical, every sitting there's measures and acquisition. June exams, there wasn't measures and acquisition. September exams, he did the free cash flow. We were using it to value a company share for listing in a stock exchange, and that is not normally acquisition, even though it's a free cash flow application for the calculation of the value of the company shares for listing. It wasn't measures and acquisition. If you look at the exams in the September, there wasn't any investment appraisals. So that pattern, we are used to that. Oh, every time there's investment appraisals, every time there's this measures and acquisition, is changing. So it's making it a bit tricky here. So I will encourage you to try and review, which I appreciate. You are a human being. It's not every chapter you will actually be so much good at. So those areas that are your stronghold, make sure you hold them strongly. Those areas that you think you are not very okay, do your possible best with it in case you go to the exam room and they are there, then at least you will be able to do something with it. So hedging foreign exchange risk. I'm going to start from the base because I know some of you haven't done F9 or you got exemptions. Okay, so let's go straight here. Exchange rate. What is an exchange rate? According to your note, exchange rate is the rate at which one currency can be converted to what? Another currency, which is a perfect definition, but I normally change this. Instead of saying rate, I will say is the price. I will show you later why I want to emphasize on the price. Is the rate that we will convert one currency to another currency. In other words, is the price at which we can convert one currency to another word currency. That is the exchange rate. When you go to the bank, the exchange rates are quoted as variable and base currency. What is the variable currency? They quote one of the currencies per one, just one of the currency, and the other currency will be more than one or less than one. So we have what is called the variable currency and the base currency. And the base currency is what the dealer, which could be the bank, is actually basing his argument on or transactions on. So when I quote $/pounds as 1.5, what have I told you? I've told you that this first currency sign there is the variable currency. And the second sign there after the slash, base, and this is the base currency. So the base currency should always be 1. The variable currency is what is likely to fluctuate, okay, and which is the first currency. So I've told you $/pound means $1.5 is equals to £1. The base currency should always be 1. The variable currency is what is moving. So the variable currency is what is given to you there. The base currency should always be 1. So the meaning of this is $1.5 is equals to £1. Apart from this, the bank will quote bid and offer prices. If we go to bank these days, you don't normally see bid, you don't normally see offer. You see we buy at or we sell at. We buy at or we sell at. Bid is the price the bank is prepared to buy. Buy what? I told you the base currency is what the bank or the dealer is transacting in. So I will buy, the bank will say, we buy at. What currency do we buy at? If I have quoted $/pound, indirectly, the bank manager is saying, my base currency is the pound, so I will buy pounds from you at the $1.5 to £1. Or we sell at, which is the offer, is that he is prepared to sell the base currency to you at that rate to the base currency. So base currency is what he is dealing with. The bid is the rate or the price the dealer is prepared to buy the base currency from you. The offer is the price he is prepared to sell the base currency to you. I know from F9 level, some of you struggle to know when do I have to use the bid and when do I have to use the offer. The common sense here is that look at what is the base currency and what the dealer is going to deal with the base currency. Is he going to take the base currency from you? If he's taking the base currency from you, he is bidding it. If he's giving you the base currency, what English word can you think of again? He is offering you. So when he is giving you the base currency, he is offering. When he is taking the base currency from you, he is bidding. Full stop. The offer should always be greater than the bid because he will want to buy the base currency cheap from you and then sell it to another person at the offer at a higher rate in order to make a profit. That profit is what they refer to as what? The spread. So the spread is the difference between the offer and the bid. The offer is also sometimes called the ask price. It's also sometimes called the ask price. Okay, what is spot and forward rate? We are just refreshing our mind on the basic ones before we move on to the main ones. What is the spot and forward rate? Spot rate is the rate that is determined now, for which the exchange of the currencies will occur on a future date. Spot rate, we determine the rate now, but the exchange of the currency will also occur now. Forward rate is the rate that is determined now, and the exchange of the currencies will happen on a future date. So on the spot, simple, that's how you can say it. On the spot, the rate is determined now for exchange of the currencies now. Forward rate, the rate is determined now, the exchange of the currencies will occur on a future date. That's it. We have determined the rate for future exchange, for forward exchange. That's it. Okay, outright quotation. What is outright quotation? Outright quotation, the exchange rates are normally presented in the form outright. Outright means we are showing the decimal places. So for instance, spot bid rate is 1.6878, 1.7694 for offer. 1 month forward rate, full decimal places given. But sometimes instead of the examiner giving the forward rate at outright quotation, he will give the forward rate as a point quotation. And the exchange rate we need should always be the outright one. That is what we need to use to what? Convert the currencies. So when the examiner gives me the point quotation, I cannot use the point quotation to exchange the currencies. It is my job to convert it from the point to what? The outright. And how will I do that? Okay, first, what is a forward rate as a point quotation? The forward rate as a point quotation is a deviation from the spot rate. In other words, when they give you the forward rate as a point, it means the examiner or the person had found the difference between the spot rate and the outright forward rate. That difference is what is given to you as the point. So when they give me the point, they have found the difference between the spot and then the forward outright. So how will I get the outright? I need to either add the point to the spot rate, or I would have to deduct the point from the spot rate in order to get the forward outright, because that point given to me is the difference between the spot outright and the forward word outright. So let's come here. So in this example 3 is spot rate, bid and offer. 1 month forward rate, forget about the premium, I will bring you on that, which is 58 and then 56. What is the meaning of that? You can't say, for instance, if this is dollar/pound, you can't say today the spot rate between the dollar and the pound is 1.44, and in 1 month's time $58 is equals to £1. The examiner has quoted it in what? Point. And when he quotes it in point, another way you can say it, he is going to indicate whether it's a premium or it's a discount, which I'm going to explain. Okay, now forget about the premium and discount for now, and then come here. Once 1 month forward rate is given to me in point, it means they found the difference between the spot rate and the outright forward. That difference is what gave me the 58. They also found the spot rate and the outright forward, and they got this 56. Okay, so for me to get the outright forward rate, I would have to either add this to that, or I would have to deduct. And whether I have to add or I have to deduct depends on whether the currency is at a premium or the currency is at a discount. Or if the currency is at a premium, we say the currency is appreciating, or if the currency is at a discount, we say the currency is actually depreciating. And I have said this before when we're doing the international investment appraisals. We said when a currency is appreciating, you will need less of that currency for the same amount of the other currency. So when a currency is at a premium, because you will need less, the answer here is it is going to be this minus that. So when it is at a premium, you are going to minus it. When it's at a discount, when a currency is at a discount, you would have to what? Get more. And as such, you would have to add. So simple terms, premium means less. And then discount means what? Add. So here, what has the examiner given it to us? Examiner has given us a premium. So once we've got a premium, the examiner is expecting us to what? Less this from that. How are you going to less it? Be with me. It's not 1.4432 minus 58. It doesn't work like that. This is how it works. Bring your spot rate. And then this 58, you have to start writing from your right hand side towards your left hand side. So you see this 58, 8 is the one here first. So the 8 should also match with the first figure in the spot. So 8, 5. Then if you have exhausted the figures, write zeros onwards. 0, 0.0. Here too is 56. So I will say 6, 5, 0, 0.0. And then because it is at a premium, that is why they are lessening. And that if you less this from that, it will give you the 1 month outright. So what the examiner did indirectly is the outright spot is this. The outright word forward is that. And the difference between these two is what gave the 58 word points. So when they find the difference between the spot and then the forward outright, that gives you the point. So when they give you in the form of the point, it's your job to reverse it back to the outright before you can exchange the currencies. Okay, so that is the point. Next is cross rate. What is cross rate? What is cross rate? Okay, sometimes you want to establish the exchange rate between two currencies, but that exchange rate is not given. But those two currencies are linked to a third currency. In that case, you have to think about cross rate. Let me give you an example. I want to get the exchange rate between the pound and the euro. A question hasn't given it to me, but the question has given me pound and the dollar and euro and the dollar. Because I have got pound and the dollar and euro and the dollar, these two currencies I'm looking for their exchange rate is not given directly, but those two currencies, they have a common relationship to a third currency, which is the dollar. So I can use their common relationship to do the proportion to establish the exchange rate between these two. And that is what is called the cross rate. You need to cross it. So cross rate is applicable when I want to establish the exchange rate between two currencies and it's not given. I would have to use their common relationship to a third currency in order to establish that particular exchange rate between the two currencies. A good question will not mention that using the cross rate, but you are solving a question and I need exchange rate, and that exchange rate is not given, but the two currencies involved, they are linked to a third currency. As they are linked to a third currency, straightforward, I can bring the principle of the cross rate. So let's take this example. If 1 yen is equals to $0.55 and 1 pound is equals to $1.6, what is the price of the pound in yen? What is the price of the pound in yen. So how much will be the exchange rate between the pound and the yen? That is what I'm looking for. But when I come here, they haven't given me the pound, the yen exchange rate. As a result, it's my responsibility to bring it out. How will I bring it out? These two currencies, yen and the pound, I'm looking for the exchange rate. They are linked to a third currency called what? Dollar. Can I do that proportion? If 1 yen is equals to $0.55, 1 pound is equals to $1.6. So if I am able to get $1.6 in yen equivalent, that $1.6 in yen equivalent will be equals to the 1 pound, because $1.6 is equals to 1 pound. So I can do this proportion as this, that if $1.6 is equals to 1 pound, which I don't know its equivalent in yen, and 0.55 what? Dollars is equals to 1 yen. If 1 yen is equals to $0.55, how many yen will be equals to $1.6? I will do that cross multiplication. Is this times that and this times that. So my x will be 1.6 times 1 yen, which is 1.6 divided by 0.55. And this is what is given. Is it 2.91 yen? So if it is 2.91 yen, what then is the principal? It means that 2.91 yen is equals to the $1.6, and this same $1.6 is equals to 1 pound. So can we imply that that 1 pound is also equals to the 2.91 yen, and you pick it from there? Okay, if you look at some of the questions and international investment appraisals, the examiner can bring cross rate in there. The examiner can bring cross rate. Anywhere you want to establish the exchange rate between two currencies, and though that exchange rate is not given to you, but those currencies are linked to a third currency, then cross rate is flashing you. Okay, always my problem is the question will not tell you using cross rate. Will you be able to see it yourself? That is all the challenge. And P4, in that bigger scenario, will you be able to see it yourself? Okay, so that is the principle of the cross rate. Now let's go and use this example to test our understanding of the bid and the offer. So consider the following exchange rate: bid and offer, dollar, sterling, sterling, euro. Required: what will be received in pound sterling by a UK company expecting to receive $400,000. The meaning of the question is, this company is based in the UK. It is expecting to receive what? $400,000. When it get the $400,000, it has to convert it into what? Pounds. What exchange rate is he supposed to use? Okay, simple. I have to get an exchange rate between the pound and the dollar. And when I come to this bank has quoted $/pounds. Bid 1.4580, offer 1.4980. Which one should I use? This is how you have to lead yourself. I know at F9 level basic, some people have learnt it. If you are receiving money, offer it. If you are paying money, bid it. It doesn't work like that always. So judge it. The common sense is the bank has quoted $/pounds. So the base currency is the pound. So this bank is telling you that I buy pounds at the bid, and this is the bid. I sell pounds at the offer. So you, the UK company, when you got your $400,000 and you want to convert it into pounds, you will go to the bank with your dollar, thinking of converting the dollar into pounds. And the moment you open the bank door, the bank manager says, we buy pounds at the bid, we sell pounds at the offer. So if you came with dollars, then it means we have to take the dollar from you and we sell you pounds. So if I will sell you pounds, because the pound is the base currency, that is what we buy or sell. So if I will sell you pounds, then I will offer you pounds. Because when you go to the bank manager with the dollar, he will offer you pounds. Therefore, we have to use the offer rate of 1.4980. That's why they use that. Okay, somebody can also say that, okay, for the sake of learning, if you had used the bid, you would have said 400,000 divided by the bid of 1.4580. What would have been the case? 400,000 divided by 1.4580. That would have been 274,348. Okay, and then you apply common sense. When we use the offer, this is what we got. When we use the bid, this is what we got, isn't it? If you go to the bank manager with $400,000 and the bank manager has to give you pounds, will he want to give you 274,000 pounds, or will he want to give you 267,000 pounds to get the 400 from you? He's a businessman. He want to give you what? Less and get more from you. That is the reason why he will give you 267 instead of 274. And if you can jack, that's what some people do. When they finish, they cancel this. I don't understand them. If you can jack that, the bank manager will give you the pounds. Then if he's giving you the pounds, which is the base currency, if he's giving, then he's offering. Therefore, use the offer rate and go. So all what I tell students is, make sure you ask yourself, what is the dealer going to do to the base currency? Let's take the next one. What will be paid in pound sterling by a UK company expecting to pay $500,000? You are based in the UK. You would have to go and pay $500,000. What will you do? I have to go and to the bank, convert pounds into what? Dollars, to go and pay whomever I am owing the $500,000. So when I go to the bank, I am going there with my pounds, trying to get dollars to pay whomever I have to pay the 500,000 to. The moment you open the door, what is the bank manager telling you? Because the quotation is dollar/pounds, his base currency is the pound. He's going to tell you, we buy pounds at the bid, we sell pounds at the offer. I went there with pounds. What is he going to do to the pound? He is taking it from me. He is buying it. Therefore, we have to bid it. That is the reason why here they bid it. Okay, that is the reason why they use the bid there. So just ask yourself, what is the dealer going to do to the currency of the base currency? Full stop. Now, C. What will be received in pound sterling by a UK company expecting to receive 400,000 euro? Okay, I am based in the UK. I am expecting to receive 400,000 euros. When I get the 400,000 euros, I would have to convert it into what? Pounds. So what exchange rate do I need? I need the exchange rate between the pound and the euro. And this is what the quotation is. They said pound/what? Euro. So the euro is the base currency. So this bank is telling you, we buy euro at the bid, we sell euro at the offer. So if I go and receive my euros of $400,000 and 400,000 euros, what will I do? I have to go to the bank with euro, converting the euro into my pounds. And when I went there, bank manager says my base currency is the euro. I will buy euro at the bid. I will sell euro at the offer. Is he going to buy or is he going to sell? he's definitely going to buy from me. Therefore, I would have to use bid. That is the reason why I told you it's not always when you are receiving, you offer it. Here we are receiving 400, but look at the quotation. The quotation has changed. The pound is now becoming the variable currency. So when they change it, your bid will go to offer. Your offer will come to bid. That is why you would have to be very careful. And as such, we use the bid rate. Second last one, what will be paid in pound sterling by a UK company expecting to pay 500,000 euros. You are based in UK, you have to go and pay euros. What will you do? You have to convert your pounds in order to go and get euro. How will you do that? I need to take my pound into the bank manager's office. When I go there, bank manager says the quotation is pound/euro. I buy euros at the bid, I sell euros at the offer. If I go there with pounds and I'm demanding euro from him, he will offer me the euro. When he offer me the euro, then I have to use the offer rate. Full stop. Okay, so when he's giving you the base currency, offer it. When he's taking the base currency from you, just bid it. Okay, just bid it. Okay, so that is basically the case. Okay, so what will be the exchange rate risk? Okay, anytime a company enter into a foreign transaction or a foreign investment or maybe a foreign receipt, then the company might be exposing itself into exchange rate movement. The moment the exchange rate move, you might make a gain or you might make a loss. That gain or loss due to movement in the exchange rate is what is called what? The exchange rate risk. Whatever we've said so far is just elementary bit. We are moving ourselves towards the level that is expected of our syllables. So the moment a company import, export, invest in a subsidiary in a foreign currency, then the company might expose itself with what? Exchange rate movement. The moment the exchange rate moves, obviously you might pay more or you might pay less, or you will receive more or you will receive less. That movement is what is called the exchange rate risk. All of them can be grouped broadly into what? Three. We have what is called transaction exposure. I do believe that at F9, some of you saw it as the short-term word cash flows. P4, you need to get the proper understanding. Cash flow, short-term cash flow transaction, a loss or a gain on short-term cash flow transaction. It could be bad debt. You haven't said anything about what? Exchange rate. So when you want to fully define what is transaction exposure, the meaning is transaction exposure is the gain or loss due to movement in what? Exchange rate. When the company enters into foreign currency denominated transaction, and the settlement will not occur now, but the settlement will occur on a future date. So when I enter into foreign transaction and that foreign transaction is in my own currency, it means the transaction is not denominated in a foreign currency. Whatever the exchange rate will be, because it is in my own currency, there wouldn't be any movement, and I will make a gain, I will make a loss. I haven't got a transaction exposure. I have got a transaction exposure if and only if the transaction is denominated in a currency other than my home currency. That's why we say denominated in a foreign currency. So don't say when you enter into foreign transaction. You have to enter into the foreign transaction, and that foreign transaction should be denominated in a foreign currency. And that time you are not paying it now, you have to pay it on a future date, because the movement in exchange rate will be between now and then. So the definition is very, very clear. The reason why I'm stressing this is I can't remember the setting. The examiner created 3 scenarios and the students were supposed to identify economic exposure, transaction exposure, and translation exposure. There is transaction exposure when you enter into foreign currency denominated transaction, and that settlement will not occur now, but the settlement will occur on a future date. What is a translation exposure? Translation exposure occurs when you have to prepare a consolidated financial statement to include a foreign subsidiary that had prepared account in foreign currency. Simple definition: you are preparing account to include a foreign subsidiary. That subsidiary had prepared account in foreign currency. It means that account in foreign currency is supposed to be converted into your currency before we can bring the two accounts together to form the consolidated account. And the exchange rate movement can change the values, and that is what is called the translation exposure. Sometimes people call it accounting exposure. Okay, last one, economic exposure measures the long-term version of the transaction. Every time you enter into a transaction denominated in a foreign currency, you might make a gain or loss. So your cash flows will either go up or go down. We said the value of the company is the present value of the future cash flows. So when my cash flows go up because of the exchange rate movement, my value of company will increase by the present value of the gain I made as a result of the movement in the exchange rate. Same way, as a result of entering into foreign currency denominated transaction, if I have to make a loss, my value of the company will go down by the present value of the cash losses, isn't it? So let's end it here, and when I come in next week, we will actually pick from here. The only thing I can say here is, which of these exposures is more important to the financial manager? Okay, transaction and economic involves movement of cash, and the value of the company has got something to do with cash flows. And we all know that the objective is to maximize the shareholders' wealth. And to maximize the shareholders' wealth, the market value should increase. Therefore, the financial manager should be concerned most with those exposures which has got something to do with money. And those ones are transaction and economic. Translation is you translating one account in another currency to bring it to your currency to prepare what? Consolidation account. It's accounting paper movement. It does not involve any movement of cash, and as such, it has got no relevance to the maximization of shareholders' wealth. So should the examiner ask you which of those exposures are important to the financial manager, your question is, financial manager, what are you there for? I am there to maximize shareholders' wealth. So any of them that will affect maximization of shareholders' wealth is what I have to be concerned about, and they are the transaction and the economic. Translation is just paper movement. So I have to thank you very much for your time this evening, and then I will see you next week for the calculations of the hedging bid. So if I haven't got any question, then I'm going to say thank you very much for your time. I'll see you next week. Thank you.